Have you noticed how everything feels stuck lately? Not crashing, not booming, just tense. Housing feels frozen. Businesses are cautious. Banks look nervous. Governments sound confident but somehow exhausted. And everyone keeps repeating the same phrase. Interest rates will stay higher for longer. But what does that actually mean? Because behind that boring sentence is something much bigger, something fragile, something that explains why so many parts of the economy feel like they're starting to crack, all at the same time. This isn't about one country. It's not about one crisis. It's not even about inflation alone. It's about a trap the global economy walked into slowly and now can't walk out of without breaking something important. And once you understand this trap, suddenly all the headlines start making sense. For most people alive today, cheap money feels normal. Low interest rates, easy credit, loans everywhere, mortgages that felt affordable, governments borrowing endlessly, companies surviving on debt instead of profits. For decades, money was cheap, so cheap that it almost felt free. And during that time, the entire global economy adapted to it. Not just markets, not just banks, but governments, households, entire ways of life. Cheap money didn't feel dangerous. It felt helpful, comforting, like oil keeping the engine running smoothly. The problem? When you build everything around cheap money, you become dependent on it. And dependency always comes with a cost. Let's simplify this. Interest rates are just the price of money. When rates are low, borrowing feels easy, spending increases, risk feels manageable, mistakes feel forgivable. When rates rise, everything tightens. Debt becomes heavy, margins disappear, errors suddenly matter. For years, rates were kept artificially low, not because it was healthy, but because the system couldn't handle anything else. Low rates weren't a bonus, they were life support. And now, that life support is being removed. Central banks didn't raise rates because they wanted to. They raised them because inflation forced their hand. Too much money, too much debt, too many years of pretending nothing had consequences. Inflation isn't just prices going up. It's a signal, a warning, a message that the system has been stretched too far. So rates went up, fast, hard, all around the world. And at first, people thought, okay, this will hurt a bit, but then things will normalize. That assumption turned out to be very wrong. Housing is always the first thing to react. Mortgages depend directly on interest rates. So when rates jump, monthly payments explode. Suddenly, buyers disappear. Sellers freeze. Construction slows. Prices stall or wobble. Housing doesn't crash immediately. It pauses, holds its breath. And that pause ripples outward. Furniture, appliances, jobs, local economies. The engine starts coughing. Here's where things get uncomfortable. Governments are drowning in debt, not because of one bad decision, but because decades of cheap money made borrowing painless. When rates were low, debt didn't feel real. Interest payments were manageable. Deficits felt abstract. Now, every percentage point matters. Debt servicing costs explode. Budgets tighten. Choices become political nightmares. Raise taxes? Cut spending? Borrow more at higher rates? None of those options are painless. All of them make someone angry. Banks live and die by interest rates. For years, they bought safe assets when rates were low. Long-term bonds, government debt, stable returns. Then rates went up. Those assets lost value. On paper at first, then in reality. Suddenly, balance sheets look shaky, confidence weakens, depositors get nervous. Banks don't usually collapse because they're insolvent. They collapse because trust disappears. And trust is fragile when rates rise fast.
So why not just lower rates again? Because that reopens the inflation wound. Lower rates mean more borrowing, more spending, more money chasing the same goods. Inflation comes back, maybe worse, maybe faster. Central banks are trapped between two bad choices: keep rates high and break parts of the system, lower rates and restart inflation. There is no painless exit. That's the trap.
This isn't local, it's global. Because for years, the entire world ran on the same model: cheap money, debt-fueled growth, asset inflation. When the foundation cracks, everything built on it feels unstable. That's why Europe feels fragile. The US feels tense. Emerging markets feel exposed. China feels boxed in. Different economies, same problem.
The hardest part is that nothing is exploding dramatically. There's no single crash, no clear villain, no obvious moment where it all breaks. Instead, things slow, freeze, stall, quietly deteriorate. That makes people doubt their instincts. Is it really that bad? Am I just imagining it? You're not. This is what structural stress feels like. Many people hope things will go back to normal. But normal was built on conditions that no longer exist: endless cheap energy, cheap labor, cheap money, expanding populations. Those forces are fading. The world is entering a different phase, more constrained, more fragile, more expensive. Interest rates are just the messenger. For regular people, this trap shows up quietly. Harder mortgages, riskier jobs, lower savings, more anxiety, less margin for error. Life feels tighter, less forgiving, more exhausting. Not because people suddenly became worse, but because the system changed underneath them. So here's the real question. If the global economy can't function with high rates, but can't survive low rates either, what does that say about the system itself? This isn't about panic, it's about awareness. Because the most dangerous moment isn't collapse, it's denial. And the interest rate trap? It's already closed. We're just starting to feel the walls.